So we'll get started with the presentation. So good evening all. So before getting into the presentation, a quick introduction about ourselves. We are Consulting and Beyond, one of the leading firm in India who's capable of providing various services to SMEs in order to increase their bandwidth and increase their scale. So we provide various services across India. Across India in various domains. So our forte is financial advisory and management consulting and audit related services. With 25 years of experiences in various sectors, we help various our clients to enhance their sales and maximize their profit. So on this line, we have prepared a webinar content on that line. So we will see it together. Before that, a quick small introduction about our firm and the services which we are offering. So our business verticals are in 4 divisions. One is audit and assurance. Second is management consulting. Third is corporate finance. Fourth is taxation. So across these 4 business verticals, we provide services to our clients in various arenas. So we would like to thank our business, today's webinar's participant and also our mentors. So our founding partner, CA Umesh Gulecha, Mrs. Ratandeep ma'am, myself Ramakrishnan, and the persons who is going to take today's webinar is Padmesh and Sri Krishnan and Mahalakshmi. So these persons are going to take care of the upcoming slides. So I would like to welcome Ms. Mahalakshmi to take it from here onwards. Thank you.
Hi, I'm Mahalakshmi. Retail expansion readiness, the 5 financial signals. So let us start with this session with a story. One, most of you have either seen happen or lived through yourself. A retailer who has 3 stores, 50 crore turnover, clean 6% PAT. The business is working. The 2 new stores open over 18 months. The turnover jumps to 72 crore. The P&L still shows profit, but the owner is taking home less. The creditor list is longer, and by the 25th, the bank balance is tighter than it should be. Why am I working twice as hard and taking home less? By the time that question gets asked, the answer is already locked in to the new shop, the payroll, and the stock on the floor of store 4 and store 5. That's what this webinar is about. Asking the hard questions before you sign, not after. Ambition built your first store, discipline builds your next 5. Why this webinar? Why now? Expansion without financial readiness doesn't give you a bigger business. It gives you a more tiring one. We are going to walk you through 5 signals today. These are the exact questions we ask in our audit room before we tell any client whether they are ready to expand. The 5 signals we'll read together. Signal 1. Is your existing branch actually profitable enough to clone? We'll let you know exactly where you stand today, the branch by branch, and what needs to be fixed before you think about the next one. Signal 2. Can your cash cycle handle a new branch without breaking the supplier's trust? The moment you open a new branch, your cash is pulled into 2 directions. We'll tell you whether your supplier payment dates will hold or it will buckle. Signal 3. Will the stock you buy match what customers actually want in the new location? What sells in your existing store may not sell in the next one. So we'll help you understand how to get buying right before the stock lands on the floor. Signal 4. Will new branches absorb your overheads or multiply them? Every new branch changes your cost structure. We'll walk you through exactly how your fixed and the variable cost behave when you scale and what to watch for. Signal 5. Do you know when the money invested will be recovered? As an entrepreneur, this is most important because you should know within how many months you'll be in a position to recover the investment made in the new shop. We'll help you understand the same. If you can answer all the 5 clearly and honestly, you're ready. If even one is shaky, that's where we spend your time today. So we have a quick poll on the screen. Which best describes your situation right now? So are you in the early stage, like 1 to 3 stores, considering your first expansion? Growth stage, 4 to 10 stores, and you're planning 2 to 3 more? Or a reality check that like you have just opened new branches recently and the numbers not matching? Or you're evaluating, deciding whether to expand, or you're consolidating? I'll give you a few seconds to answer the same. Most of you have answered growth stage. That is, your plan. You already have 4 to 10 stores, and you're planning 2 to 3 more. So you have done this before, which means you know what expansion actually feels like from the inside. The question now is whether the next 2 or 3 branches are built on stronger foundation than the last ones. That's exactly what we're here to check this session. So before we read signals, one principle. Keep this in your mind. If the existing store cannot run without you physically there, you're not expanding a business. You're only adding more places where you have to be. So one honest question. Can your existing store run for 3 full days a week without you in it? Not survive, it should actually run. If the honest answer is no, the discipline to manage a second location doesn't exist in the business yet. It exists in you, and you cannot be cloned. This is the starting point. Let's build it from here. Signal 1. Is your existing branch truly profitable enough to clone? So, 3 questions you should ask yourself before expansion. First one, which branch made the most profit after turnover last year? In rupees, not percentage. Second one, which branch made the least and what's the gap between the two? And third one, what's the net margin of the branch you want to clone after you have loaded every single rupee of your head office cost against it? In 25 years of doing this, the number of retailers who can answer all three in under 30 seconds is less than 1 in 10. So the core idea is you cannot clone what you cannot measure. Branch P&L, the non-negotiable. So the most branch P&Ls capture the revenue, COGS, the direct costs like rent, electricity, and stuff. So far, it's okay. But here's where the truth starts hiding. The allocated central cost, the head office salaries, the accounting team, the warehouse, the IT, the MD's own salary. So all of that exists because the branches exist. But when it doesn't appear in the branch P&L, it actually looks more profitable than it actually is. So the interest on capital deployed, for example, to open and run a branch is rarely allocated to that branch. So the correct approach is to allocate the OD interest based on each branch's actual working capital utilization, not on its share of sales. Next, the depreciation. Depreciations are frequently consolidated at the head office, and it never appears in the branch's financials. It should be allocated directly to the branch where the asset is deployed. The MD's salary. So the common practice of spreading the MD's salary across all the branches proportionally is actually flawed. It dilutes the accountability and misrepresents the cost structure. The MD's salary should be treated as a fixed headquarters cost, and it should be allocated to the branches on a rational, on a consistent basis. It should not simply be divided by the headcount or the revenue. So core rule is this. A branch must at least deliver a 5% net margin after all the costs are loaded to be worth loaning. It is not 5% contribution, not 5% gross. It is 5% net after everything. So a branch that shows 8% contribution but minus 2% after loading all the cost is not a profitable branch. It is a hidden drain on the branches that are profitable. So a 3 crore story, for example, it is a textile retail chain having 17 branches. One branch opened 30 months ago. They celebrated it internally. Footfall meeting plan, the top line meeting plan. Then we built a full branch level P&L. The revenue is around 14.79 crores. The gross contribution is 3.8 crores, which is 25.7% of the revenue, and it looks reasonable. Then the real cost, the rent and the direct staff, which is 2.9 crore, launch marketing amortized 1.1 crore, and the finance cost 1.2 crore. Allocated head office cost is 1.65 crores. So the total cost below the contribution is 6.85 crore against the 3.8 crore of contribution. So the branch net is minus 3.05 crore. The branch everyone thought was contributing was absorbing 3 crore a year from the other 16 branches. While the consolidated P&L hid it, the averaging effect. First of all, the 3.05 crore was spread across the 17 branches, which became a margin dip of just 0.35%, which is invisible on the consolidated P&L. Next, the capex finance cost. The ambitious capex produced a finance cost which no single year of revenue could absorb. Then the marketing assumption failure. Launch marketing was treated as a 1-year write-off. It never delivered the footfall the projections assumed. Then the benchmark gap. The best branch in the same group was running at 9.9% EBITDA. This branch was 2 full cycles behind it, and the owners didn't know. The digital lens. E-commerce is not a branch without rent. For those thinking about e-commerce as a part of expansion, here's what the unit economics actually look like. First, the marketplace commission, 15 to 25% of the sale value of the top. Then the returns rate, it is 25 to 40% in fashion or textile, but in case of a physical store, it is only 5%. Then photography, packaging, logistics, it is around 25 to 40 per order, and the payment cycle is 7 to 21 days and not in the same day. Digital marketing, in case of own site, around 1 to 3 lakh per month at least, and earmarked inventory is 10 to 20 lakh blocked, not sellable offline. So, if your contribution margin after the platform cost is below 5%, you're not growing online. You're subsidizing the Amazon's logistics network with your working capital. Here's a quick poll in front of you again. Please take a minute to answer. When you look at your best branch, do you know its net margin after fully loading all the head office cost, finance cost, and the depreciation? Yes, above 5%. Yes, below 5%. Partial picture and not calculated. Please take a moment to answer. Most of you have answered yes, above 5%. That is exactly where you want to be. A fully loaded net margin above 5% is the benchmark we look for before any expansion conversation. Hold that number and make sure it holds across 2 consecutive years and not just 1. Thank you for your responses. So next, what you are reading for. So how many of you know with precision, not a feeling, the net profit margin of each branch, not the group number, each branch individually after every cost has been allocated to it? Most retailers don't. They have a group P&L and a gut feeling about which branch is doing well. Gut feelings are valuable, but you cannot expand on a gut feeling. You expand on a number. The net margin of each branch you're about to clone. Signal 1 checks 5 things. First, a clean branch P&L with all the central cost fully allocated. Your best branch margin is known to the first decimal. Your worst branch identified and whether it's absorbing from the profitable ones. Then, the clone-worthy branch delivering more than 5% net margin for 2 consecutive years, and then a written projection for the new branch that reaches this benchmark within 18 months. Action plan. So do not add more stores, add more profit per store. Then expansion becomes a reward and not a risk. So 2 actions for this week. First, ask your accounting for a fully loaded branch P&L, every branch from last financial year. HO salary, MD salary, the finance cost, the depreciation, the warehouse, all of it should be loaded into the P&L. If the sum of the branch profit doesn't equal the group profit, something hasn't been allocated, pushback. Then you have to rank the branches from the highest to lowest net margin. That list will tell you more about the expansion readiness than 3 months of site visits. So if your account team says, we don't have the data structure this way, that answer is defining. You have to fix the data structure first. Signal 2. Can a cash cycle fund expansion without breaking supplier trust? Profit is an opinion. Cash is a fact. Expansion multiplies both. So your P&L shows profit on accrual accounting. Cash follows a different rhythm entirely. When you expand, the gap between your P&L profit and actual cash in the bank becomes a very uncomfortable place to live. 4 questions to think through. Have you arranged the CC or OD facility covering 90 days of new store working capital? Second, if creditors asked for a full payment in within 30 days, how many branches could pay without borrowing? Next, what is the cash cycle gap between your best and the newest branch? Fourth, has anyone written down when the new branch becomes cash positive and on what assumptions? The cash vacuum every new branch creates. So here's what opening a 10,000 square feet retail branch actually costs before even a single customer walks in. So opening stock at cost, this is around 1.5 to 2.5 crore. Then rent advance and the security deposit. This is around 15 to 40 lakhs. Next, the fit out, interiors, signage, etc. That is around 70 lakhs to 1.2 crore. And then IT, POS, CCTV, furniture, 10 to 20 lakhs. Staff recruitment and 30 to 45 days of training to them, 8 to 15 lakhs. Launch marketing and the inauguration, 10 to 25 lakhs. Working capital buffer for the first 90 days, 40 to 80 lakhs. So the total upfront cash requirement to open a new store is 3.5 to 6 crore per branch. So all of this leaves the bank before even the first customer walks in. Meanwhile, your existing branches still need to pay suppliers on the 25th of every month. The working capital stress test. Expansion ready working capital. Current working capital in days and add the new store initial stock days and the 30-day buffer. So if your current cycle is 120 days and a new branch needs 90 days of opening stock, your buffer must cover 120 plus 90 plus 30. That is 240 days. If your cash and the sanctioned CC and the undrawn OD doesn't cover 240 days, you're not expansion ready. You're expansion enthusiastic. A wonderful quality in a founder, a dangerous one in a CFO. The supplier who became the bank. A disciplined operator who's profitable for 12 years. He opened a new branch, 5 crore of capex expenditure, 35 crore. First year sales projected at 2.9 crore per month. When they didn't arrange a CC facility sized for the new branch, a tested assumption on local spend behavior, and a written plan if sales came in 15% below projection. So the monthly sales was projected 2.9 crore, but the actual was only 1.7 crore, shortfall of 41%. And the stock aged past 90 days. That is 1.8 crores of stock sitting idle. And the creditor days stretched from 60 to 140 days. Today, 20 months later, the group is arranging a CC facility, not a fund growth, to pay off the suppliers who have been carrying the business for 14 months. The suppliers became the bank. A properly sized CC facility arranged before opening would have made the sales shortfall a cash flow challenge with a supplier relationship emergency. The fix was available, it just wasn't arranged. The e-commerce cash cycle nobody wants you about. For those of you running a physical stores and e-commerce together or planning to, this one matters because the moment you do both simultaneously, you don't have one cash cycle to manage. You have two. And if you don't map them separately, one will quietly drain the other. Here's how the settlement timelines actually work. In case of a physical store, customer pays you today. Money in your account by tomorrow or day after. Fast, it is clean and predictable. You know this rhythm. But in case of marketplace like Mindra or Ajio, customer pays today. you'll receive it somewhere between day 7 and day 21, not day 1, not day 2, day 7 to 21, depending on the platform's settlement cycle and how many written windows have closed. Own website where there is a pay or pay you. Customer pays you today. You receive in day 2 to 3. That is reasonable, but still not the same day. Then cash on delivery via marketplace. Customer pays on delivery. You receive the cash on day 5 to 8. This is the one that caused genuinely surprising cash squeezes in businesses that then model the float. E-commerce and physical expansion means two working capital cycles to fund simultaneously. Mark them separately, or one of them will drain the other. Again, a quick poll. Before your last new branch opened, did you have a sanctioned CC or OD facility specifically sized for that branch working capital requirement? Yes, before opening. Yes, but late. No supplier credit and not yet. Please take a moment to answer. Thank you for answering honestly. So yes, most of you have answered yes, about 5%. This is exactly where you want to be. A fully Give me a minute. So most of you have answered before opening, size and sanction before opening day. Signal 2, what you're reading for. The green light checklist. Current cycle calculated in actual days, not estimated, not calculated. Additional cash quantified, upfront and first 90 days. Sanction CC or OD in writing from the bank before signing the lease. Downside plan testing. What happens if month 4 sales are 70% of projection? Supplier relationships healthy. No critical supplier currently strained. They are fixed at first. So expansion does not fail because of the bad locations. It fails because cash ran out before the new store could stand on its feet. Action plan. 2 actions this week. First, the creditor aging audit. Pull last 6 months of creditor aging. If more than 20% of the suppliers are more than 60 days overdue, the existing business already has a cash problem. Solve it before signing any new lease. Next, meet your banker this week. Walking with your current cycle in days, projected cash requirement, and expansion plan, not just last year's P&L. Bankers don't say no to well-structured proposals. Give them the numbers to say yes. Arrange the cash before you need it. When you're in a position of strength, not necessity, that is the discipline that separates businesses that scale from businesses that struggle. That brings us to the end of signal 1 and signal 2. I'm going to hand it over to Krishna now, who will take you through signals 3 and 4. Over to you, Krishna.
Thank you, Maha, for your valuable insights. Now let us look into the signal 3, whether your buying model handle 2 to 3 locations at the same time. The question I want you to sit with for the next few minutes is, can the same person accurately purchase for next 10 locations, each with a different customer profile, each different level income, different brand preferences, not just completely, accurately, with the right merchandise hitting each branch at the right time, in the right quarterly, in the right quantity, at the right price band? Because here's the thing, one buyer's instinct, it magnificent for 3 stores, it is a liability for 10. The instinct doesn't scale. The instinct was built on one type of customer. At 10 branches, you have 10 different types of type customers. So I am going to raise 5 uncomfortable questions to you. I will walk you through each one of them. And one branch manager accurately purchase for 10 locations with 10 different customer profiles? Does your inventory system give live stock visibility across all locations? Do you have a written policy for inter-branch transfers of excess stock and shortage fulfillment? Do you track stock turnover ratio by branch by category with different targets for each? Have you done a detailed area assessment for new branch, or did you just assume it's similar to an existing branch? I have a story for you. A well-established textile group which has 3 branches in a tier 3 town, all performing well, solid turnover, decent margins, happy owners. They find a new location, same kind of town, roughly. Similarly, population size, similar growth, geography, similar distance from the nearest city. And here's what the team did. They looked at the new town, looked at the existing branches, and decided it looks the same, feels the same. Let's just copy the buying plan. So the merchandise mix they opened, which has 60% of the stock in the 300 to 900 price band, primarily unbranded or regional branded merchandise, low share of national brands, exactly what worked in the other branches. But what the assessment actually results, predominantly office class workers and salaried professionals households were lived there. People with a fixed salary hitting their account on the first of every month, and these customers wanted national brands. They wanted to walk into some point of the shop and recognize a reasonable logo. They were not interested in the unbranded shirts. 65% of the actual customers demand was in 1000 plus segment. The store has 80% of its stock sitting in the 300 to 900 band. It's like opening a fine dine restaurant and stocking your kitchen for snack items. The kitchen looks busy, but the customers are walking out. But in the conversion rate, half of their benchmark branch. Dead stock by month 18 is 2.4 crores at cost, sitting in shelves, not moving, gathering dust and interest charges simultaneously. And here's the part that really hurts. Cost growth outpaced the sales growth for 2 consecutive years. 2 full consecutive years were spent understanding the customers actually wanted. The 2 full years of stock decisions looked the branch into a cost structure that was wrong for its assessment, and every subsequent purchase had to fight against the initial wrong imprints. The lesson I want to take from this is, if the 2 localities look similar, assume they are different until the data proves otherwise. This is how experienced retailers think. All right, now we need to buy differently for different branches. How do we structure that? Do we buy centrally from the head office, or do we let each branch manager do their own buying? This debate is older than the most retail businesses in this country. And I will tell you right now how there is no universally correct answer, but there is a wrong way to frame the question, and most people frame it wrongly. Central buying has strong vendor negotiation, has lower price per unit cost on common categories. You can walk into a supplier and saying, I am buying for 8 branches, give me the bulk price. And the supplier, who absolutely does not want to lose 8 branches worth of business, will give you a smile and a better rate. In distributing buying, you have a better local alignment. Your Coimbatore branch manager knows Coimbatore customers in a way than a head office branch manager. Central buying works beautifully when 70% or more of your SKUs are common across all the branches. Distributed buying works beautifully when the local preference varies by over 30%. The problem is more retailers haven't actually measured this. They pick just a model based on how they grew up, how they did in their early years. But here's my honest view. The model you chose matters less than the financial control you built around it. Without branch level STR, without aging analysis, without weekly stock audits, neither model will save you. You can have most elegant central buying structure in the world. If nobody is measuring the turnover per branch per category, you will discover the problem in 20th month, not in the 3rd month. And in the month of 20th, the problem cost rupees 2 crores and a very uncomfortable conversation with your bank manager. Let me talk to you about STR. I know some of you track this. Some of you track a complete level average, company level average, and a small number of you track in per branch per category with a different target for each. The last group is the top 10%. That's where the money lives. Here's the benchmark I want you to write down, not approximate. These are the ranges we will see in the well retail chains. In a textile retail, in a value segment, 3.5 to 4.5 times per year will give you a good return for the well retail chains. That's roughly around 80 to 150 inventory days. In the branded segments, 4 to 5 times per annum, which gives around 73 to 90 inventory days. In a departmental or FMCG sectors, 10 to 14 times per annum, which gives around 26 to 36 inventory days. In a jewelry segment, which heavily invest on gold, which gives around 1.5 to 2 times per annum, which gives 180 to 240 inventory days. In a diamond or fashion jewelry, 2 to 3 times per annum, which gives around 120 to 180 days. Now, here's the critical part for a new branch. You don't walk in on day one at full benchmark. The ramp up period is real and you need to budget for it. By the end of month 6, target 70% of the benchmark STR. By the end of month 12, target 100% of the benchmark. If STR is below 50% of the benchmark, at 9th month, stop fresh buying. Liquidate before you buy more. I know it sounds uncomfortable. Stopping buying feels like admitting defeat. It feels like a branch is failing. But I will tell you what actual failing looks like. It's month 18 and you have a mountain full of slow moving stock. You have been discounting for 6 months. Your margin have been collapsed and you are asking your working capital lender for one more extension. That's the failure. Stopping at 9th month and liquidating intelligently is a discipline that experienced operators use, the one who are still around 20 years. So here's a line worth memorizing. Frame it, pin it, and set it as your phone wallpaper, wherever it takes you to keep it front of your mind. If more than 15% of your existing stock is older than 180 days, you are not ready to expand. Liquidate the aged stock first. Now, when I say this in our session, I usually get one of the 3 reactions. One, the owner looks at me very calmly and says, we are at 8%, so we are fine. 2, the owner gets slightly defensive and say, we track this very carefully. 3, the owner very quiet and then say something like, we need to look at that report. The third reaction is actually the most honest and it's far most common than the first 2. In 9 out of 10 cases, retailers who report that stock is fine on the monthly P&L often have 20 to 30% of the aged stock when we run a proper aging report. The P&L doesn't show it because the stock is carried at cost, not at net realizable value. The P&L is not lying, it's just not telling the whole truth. What aged stock costs actually? Let me break it down. Cash that should be funding your new branch is locked up in the slow movers. You are essentially lending money to the shelves at zero interest. Every month, aged stock should get deeper discounted to clear it, which compresses your margins systematically. Storage, handling, depreciation, and insurance. You are paying a monthly rent for stock that isn't selling. And here's the soft cost nobody budgets. Procurement credibility. Your buyer, who currently moved hot stocks last season, is now in monthly meetings defending why this didn't sell. This erodes decision-making confidence over time. So you are planning expansion. Before you looking at the new branch location, before you are looking at the rent, before you starting dreaming about the grand opening, run a stock aging report for every month in the existing branch. To summarize, let me give you the 5 things Signal 3 is checking. These are not options. These are structural requirements for buying a model that can scale. STR is to be measured per branch per category with a target set for each, not a blended average. Aged stock over 180 days should be under 15% and to be reviewed monthly, not quarterly. A detailed area assessment is to be documented for the new branch, not to be assumed. Documentation should be in a written form. The merchandise mix for the new branch is to be designed around the documented file, not copied from the existing branch. Inter-branch transfer and exception report policies ought to be written. So the action plan for Signal 3 is very specific. Run a stock aging report for every branch this week. And if the new branch is not yet open, Commission a proper encashment study, budget 3 weeks and 1.5 to 3 lakhs. That is a genuinely cheapest investment you will ever make. Compare it to 2.4 crores of tech stock and a 2-year hole in your P&L. Procurement for a new branch is not a bigger version of procurement for an existing branch. It is a different question. Answer the question first. Now let us see to the signal 4. Will new branch absorb your overheads or multiply them? I want to tell you something about a sentence I hear almost every week in some of the versions or the other. We already have the head office, the accounts team, the warehouse, and the MIS and the other reports management. So one more branch won't add that much. That's partially true, but this sentence is dangerously incomplete. The head office infrastructure you built for 3 branches won't design for the 4th. It was designed for the 3. Adding one more branch to it is adding like a 3 more floors to a building that was structurally cleared for 3. At some point in time, something bends. The insight in the signal 4 is this. Most overheads are not fixed. They are step functions. They look fixed. They stay flat for a while and they jump. And when they jump, the jump is that they jump in the ways you didn't budget for at a time you didn't expect. Let me walk through a cost stage one by one and tell you what they actually do, not what you hope for it. For example, rent, that this is 100% incremental, has zero leverage. You would be surprised how many expansion plans are built with rent as a rounding error, budget full with escalation. If that branch has a 8% annual escalation, model that 8% into year 3 and year 5. Next is branch staff, 80 to 90% incremental. We need people to open and run the branch. Budget near full and account for 3 to 4 months of training ramp up where productivity is lower than you expect. Next thing, IT, POS, and software licenses. This is a step function. It stays flat. Then at the 6th branch, it jumps. And at the 10th branch, it jumps. And again at the 15th branch, it also jumps. The moment you outgrow your current system and need of upgrade, you are not paying for one extra license. You are paying for a whole new implementation. Then for accounts and finance team, one additional person per 3 to 4 new branches. The accounts team that handle 2 branches will not handle 8 branches without falling apart. Budget for the additional account proactively, not reactively. After closing process takes 12 days every month. For MIS and reporting, invest before crack, not after. This is the one everybody delays. Everybody thinks we will upgrade the reporting once we are bigger. No, upgrade your reporting so that you can manage being bigger. The sequence matters. And the most underpriced cost of all, it's the owner's time. In many SME retail businesses, the owner is the quality control department, buyer, and the CRM department. The owner is the final escalation point for every problem that nobody below them could solve. This is literally 4 full-time jobs packed into a one human being. When you open 3 more branches, you are asking the same person to do 12 jobs. And I say this is very completely serious. Something breaks. Usually it's the owner. Which brings me to the something we covered in an earlier signal. The existing store must be able to run without them for at least 3 days in the week for the next one opens. This is not a recommendation. This is a structural prerequisite. The formula to remember is this. The cost of opening a new branch is not just the incremental cost of that branch. It is the cost of the new branch plus the quiet upgrades your head office infrastructure need to carry all the branches well. Let me give you the reference benchmarks we see in the healthy retail chains with 5 to 15 branches. These are real numbers from the real businesses. For rent, 3.5 to 6% of the sales, highly location driven. If you are above 6%, you would better have the footfall to justify it. Direct branch staff, 5% to 7%. Head office and admin salaries, 2% to 3%. Warehouse and logistics, 0.8 to 1.5%. For IT, POS and software, 0.4 to 0.8%. Marketing, excluding the launch spend, 1.5 to 2.5%. For finance, 1 to 2% if funded by loan, or 0.3 to 0.6% if funded by working capital. For depreciation, 1% to 1.8%. So the total operating overheads comes around 16 to 22% of sales. And in this cost structure, a healthy profit after tax is 5% to 8% for a new branch. Now here's the test. Pull out your own P&L and map it against these benchmarks. If you are above the healthy range on any single line, find out why. Before the opening, the next new branch. Before expansion, before expansion doesn't compress overhead percentage automatically. It amplifies them. Let me tell you a story. Next, let me tell you a story. A departmental branch opened 22 months ago in a high street location. You know the location your team sees and says, this is it. This is the prestige address. The rent was rupees 5.8 lakhs per month, 8% escalation annually. The projection assumed 3.2 crores per month in sales. At that number, rent was 1.8% of sales, comfortable, normal, not alarming. Actual monthly sales settled around 1.6 crores, half of projections. The rent didn't change because the sales didn't perform. It's a fixed cost. So the rent as a percentage of actual sales became 4.35%. By 18th month, rent plus finance cost together hit around 6.1% on sales. Gross contribution left for the staff, utilities, and marketing head offices and profit comes around 11.6%. The branch went contribution positive to net loss after HO allocations in 22 months. And here's the collapse part. The rent was not a wrong commercial decision in the isolation. At 3.2 crores sales, it was fine. The problem was merchandise mix didn't match the assessment, which tanked the conversion rates, which tanked the revenue, which turned the rent from 1.8 to 4.35%. That's a cascading effect. One wrong assumption compounded monthly. The rule I want you to apply before you enter into the new branch, model the rent at three scenarios. 100% projected sales, 75% projected sales, 60% projected sales. If the rent at the 60% of the projected sales is above 6%, the project is too aggressive. Do not think about it. Let me talk about the break even. Every expansion plan has a one, and in my experience, almost every expansion plan under budgets it. For understanding, let me give you through an example. You are planning to open a departmental shop of 8,000 square feet in a rented premises, which you are paying a rental deposit of rupees 10 lakhs. And for interiors and fittings, you spend around 60 lakhs. And for inventory, for 60 days sales plus 30 days buffer stock, you are paying around rupees 50 lakhs. So total funding required will be 120 lakhs, for which you have funds from the creditors credit period around 40 lakhs. So the net funding requirement will be 80 lakhs. At the profit of 80 lakhs, you will achieve break even. That is, you will recover the invested money. So let us assume you get the 5 lakhs per month as a profit. You would achieve break even in 16 months. Here is the realistic break even timelines. In a small format under 5,000 square feet, 8 to 12 months will be taking as a standard break-even timeline achievement. For a medium format, 5,000 to 10,000 square feet, 14 to 20 months will be taking. For large format over 10,000 square feet, 18 to 30 months will take. For a flagship format over 1 lakh square feet, 24 to 36 months will be take. The rule is simple. Budget 1.5 times the expected break-even timeline. Under provisioning, the ramp-up period is the single biggest cause of expansion cash dying at 9th month. Why 1.5 times? There are 4 major reasons. Sales projections are almost always optimistic in year 1. Merchandise mix adjustments take 2 full seasons to settle. You buy once, learn, adjust, buy again. That's 2 seasons. That comes around 12 months minimum. Local brand recall takes 12 to 18 months of consistent marketing to build. The first 6 months, you are still the new shop. Customers are still figuring out if they still like you or not. Staff productivity ramps up slowly. A new hike takes 6 to 9 months to settle, like a trained veteran. You are paying full salary from day one. You are getting a partial productivity for the first 9 months. So if your plan says break even in 12 months, budget for 18 months. So to summarize, the 5 things Signal 4 is checking is, the total increase in the head office overheads caused by the next branch, not just the rent and the staff, all the step functions included. You have budgeted for step function, jumps in IT, accounts, warehouse, and MIS. Your break-even assumption is at least 1.5 times the optimistic projection. Rent as a percentage of projected sales is under 5.5% at full projection and under 6% at 60% of the projected sales. The owner's time for the next 18 months has to be pre-located and is not required daily at the existing store. The action plan for the Signal 4 is perhaps the most clarifying exercise. Build a 60% of projected sales scenario for your next branch. Complete it. Look at the number. Can you survive? Does the group still breathe at 60% of the projection in year 1? If yes, you are ready. You have the buffer, the structure, and the cost discipline. If no, you are not ready. And that is not a failure. This is information. Valuable information, the kind that costs you nothing now and saves you everything at 18th month. The test for overage readiness is deceptively simple. If the new branch hits only 60% of its projection in year one, does the group still survey? That is the real break-even test. Not whether the optimistic scenarios makes money, whether the realistic scenarios doesn't break you. Now I hand over to Padmesh for the signal 5.
So thank you, Krishna. That was insightful. So, hi, this is Padmesh, and for the next few minutes, we are going to talk about something that is very crucial in retail expansion conversations, and that is money, specifically your money. How you fund your next branch, how much debt is too much, and one ratio that will give you mathematical clarity regarding whether your expansion is going to fly or flounder. Let's move on to the signal 5, that is funding plan aligned with the expected return on investment. Let me start with the what I call question beneath the question. So when most retailers plan a new branch, the question they ask is how much will it cost to open? That is a wrong question. Not because cost doesn't matter, it absolutely does. It's wrong because it focuses only on the input and not on the outcome. The right question is the one every serious retailer must write down, not just think about or just discuss over a coffee time. Is within how many years will the new branch return the investment made in it? And what assumptions have we made about the sales, margin, and ramp up? Notice I said written down, not discuss, not assume, right? Because when it's written, it becomes a plan. But when it's only on your head, it's just a wish. So a branch that has 10,000 plus square feet of saleable area should return the return on investment within 3 years. That's a healthy benchmark. And a branch that doesn't return your investment within 4 years has permanently reduced the return on capital employed of your group, not temporarily, permanently. Now, I just used the word return on capital employed, and I want to make sure that we are all on the same page because this word gets thrown around in boardrooms and finance meeting like everyone knows what it means. So let me give you the simplest possible explanation. ROCE stands for return on capital employed. It answers one question. For every rupee I have put into this business, how many rupees am I getting back? Here's a dead simple example. Imagine you have 1 crore invested across your entire business in your shop, fit outs, and your stocks and everything. And at the end of the year, your business earns 15 lakhs in operating profit. Your return on capital employed is 15%, meaning every 100 rupees you put in is generating 15 rupees back. That's healthy. Now you open a second branch, you put another 80 lakhs, but the branch after 4 years is still only generating 4 years as a profit per annum. That's branch individual ROC is poor, that is 5%. And here's the brutal part. The underperforming branch is now sitting inside your group's number and pulling over overall average down. The first branch might be doing 15%, but because the second branch is dragging at 5%, your group ROCE is now somewhere in the middle and dropping every year at the second branch underperformance. Think of it like your class school percentage. You score 90 marks in 4 subjects, but you score 30 marks in one subject. That one subject didn't just fail you, but it pulled your entire aggregate down. Your parents weren't impressed by the 90 marks you scored in the 4 subjects. They only ask about the 30 marks, even though it is a failure. So that is exactly what a weak branch does to your group's ROC. It doesn't stay in its own corner quietly. It bleeds into everything, which is why the 4 year rule isn't just a benchmark. It's a protection mechanism for health of your entire business, not just new branch. So 5 years, a branch that doesn't return your investment within 5 years is a structural drag. Every year that follows make your group's overall returns worse, not better. Think of it this way: if your first branch is an engine of your business, and your second branch should be a turbocharger, it should add power. But if the five after 5 years have been passed and your new branch still isn't profitable, you haven't added a turbocharger. You just added a flat tire, and you're still driving. So now let's talk about the funding. There are two sources of funding for retail expansion, and how you use them matters as much as how much you raise. One is internal accruals and working capital optimization. Internal accrual means your own money, retained profits, earnings you haven't spent. The cost of this capital that is very lowest. It's just an opportunity cost. The rule is always use this first. Ideally, 25 to 35% of your expansion funding should come from here. And another internal source is working capital optimization. What does that mean in practice? It means you collect from your customers fast and pay your suppliers little slower and reduce debt stock. You literally find money that was already sitting inside your own business. Cost of this nearly zero. And here's the kicker done right. Working capital optimization can fund 65% to 75% of your capex without taking a single rupee of debt. Another source, that is source two, is debt, that is term loans and loans against property, costing 9 to 12% interest per day per annum. So you will likely need some debt. That is completely fine. Debt is not an enemy, but misused debt is the enemy. So the recommended funding mix for SME retail expansion is 30% internal accruals and working capital optimization, and 70% of term loan and other debts. And here's the single most important insight on this slide. The reason debt gets missized in most SME expansion is because the loan is sanctioned before the cash flow is tested. The loan determines the plan. It should be the plan that determines the loan. Most people walk into the bank and ask, "What will you give me?" Then build their expansion around that number. It should be completely opposite. Figure out exactly what your expansion needs, model the cash flows, and go to the bank and say, "Here's what I need, and here's precisely why it works." So think of it in this way. Why would you set your wedding budget based on your credit card limit? I hope not. You figure out what kind of wedding you want and then figure out how to fund it. Same logic applies here. So I want you to introduce to a four-letter concept, that is DSCR, debt service coverage ratio. Now, before I give you the formula, let me tell you what this actually is. Because the name sounds like something your CA invented to make you feel nervous in a meeting. It isn't. DSCR simply is a test that tells you whether your business earns enough money every month to pay back what it owes to the bank. That's it, no more, no less. For example, think of it like imagine you borrowed 50,000 from a friend and you agreed to pay back 5,000 every month. Now, if your salary of the month is 8,000, you can pay comfortably. But if your salary of the month is 4,000, you cannot. You're short and your friend is not happy. DSCR is the same exact calculation done for your business every single month. Now, who runs this DSCR test? The bank runs it. Before they sanction your loan, and again every year when your accounts are filed, they look at your annual profit figures, plug in the formula, and decide whether you are a healthy borrower or a risky one. But here's the problem. Banks look at the annual number. One big festival quarter can make your annual DSCR look perfectly fine, even if three other months were quietly terrible. So based on what this test runs, the inputs are simple. Three numbers: net profit before interest and tax, and your principal repayment, and then interest. So put together, DSCR is equal to net profit before interest and tax divided by your principal repayment and interest. So here is how you should read the numbers. If your DSCR is above 1.5, it's healthy. You can observe a bad quarter and still meet your obligations. If the number is around 1.2 to 1.5, it's tight. One underperforming festival season, one delayed supplier, and repayment is already strained. If the number is somewhere below 1.2, then it is danger. Any shortfall triggers default risk. If the number is below 1, the business cannot survive the debt from operations. Full stop. Now, here's what most people miss, and that is critical. Your expansion DSCR must be above 1.5 in every single month of the year one, not on annual average. Every month. Why? Because retail is seasonal. An annual DSCR of 1.5 sounds perfectly healthy, but hidden inside the average could be 3 months where your DSCR is actually zero point 0.7. Those 3 months, that's when working capital gets stretched. And that's when supplier payments get delayed. And then when the expansion stress snowball starts rolling. Banks look at annual averages because that's how their model works. Reality doesn't care about annual averages. Reality looks at the monthly cash flow. So you must too. Now I want to share you something real with you, not a framework, not a textbook example. A retail branch opened 14 months ago directly from our audit files. Same general group profile as many businesses you would recognize, same competitive environment, but this branch is different because it worked. What did they do differently before signing the lease? First, They commissioned a 4-week catchment study, not a gut feeling, not a WhatsApp poll, a structured study that named the dominant customer segment, the household income band, competitive brand presence, and the preferred price brand. Second, the merchandise mix was designed for the specific catchment, not copied from the existing branch. There is a massive difference between copying what worked elsewhere and designing what will work here. So third, they produced a return on investment analysis projecting 3-year payback. But here's the important detail. They also ran it at 60% of their best case scenario, a stress test. And even in the stress scenario, the branch would break even by month 14. So the fourth, a cash credit facility. Just a second. The fourth one is a cash credit facility was sanctioned before opening day, not as a backup emergency fund, as the planned operating instrument. Fifth, and this is my favorite, the owner committed to being at the new branch 2 days a week for the first 6 months, then 1 day a week thereafter. Not every day, because the existing branch was running on systems, not on owner's daily presence. That last point deserves a moment. One of the most common mistakes in retail expansion is owner becoming so absorbed in the new branch that the original branch begins to underperform. You haven't expanded, you haven't just relocated the bottleneck. The retailer avoided the trap. They built the system first, then they need to expand it to it. So, what did the discipline actually produce? Straight from the audit file, 14 months. So, this is the numbers as a result I'm showing you. So, monthly sales versus projection 95 to 105% hitting the plan every single month. Gross margin within 1%, point of the benchmark branch, margin discipline intact from day one. Net profit in month 14, 5 to 7% at target level for a new branch. Age stock over 180 days. Under 8%, fresh inventory, healthy sell through. Sell through rate, 85% of the group benchmark on trajectory to 100% by month 18. So DSCR, lowest month of the year 1.42 above threshold, and their own comment in the audit file, learning aim higher next time. So I love that. So 5 to 7% net profit in the first 14 months is a strong start for a new branch. This is what aligned expansion looks like. And the difference between this story and every other story where expansions underperform was not location, not a brilliant product. It was design, catchment, stock mix, funding, owner availability. All of it thought through before the lease was signed. All right, we have a live poll on your screen right now. I want you to be honest, not with me, with yourself, because the only person in the room you can truly cannot fool is the one looking back at you from your bank statement. So the question is, for your next planned branch, which of the following do you have in writing today? Option A, return on investment projection with documented assumptions. B, DSCR calculation for every month of year one. C, sanctioned CC or OD facility sized for the new branch. D, catchment study documented, not assumed. E, all of the above, or F, none of the above. So, as expected, the answer is none of the above. So that's perfect. That means you are here at exactly the right time. By the end of today, you will know precisely what to go build. 5 things you need to be able to say yes to in writing before you sign the next lease. If you have a return on investment analysis with 3 scenarios: optimistic, base, and stress. Expected payback is within 3 years at the base case, within 4 years at the stress case. DSCR is above 1.5 in every month of year one in the base case. Funding mix is balanced, 40 to 50%, around 30% in internal, and debt around 70%. Loan tenure, EMI match your projected cash flow, not the bank's default template. Till now, what we saw, let's put it in the form of a scorecard and then rate it together. I want to leave you with something you can use this week. A 10 checkpoint scorecard, 1 point for every green, 0 for anything amber or red. And be honest, nobody is checking your answers but you. First one is branch level P&L with full central cost allocation for every branch. Second is existing best branch has 5% net margin after all loadings for 2 consecutive years. Third, aged stock over 180 days is under 15% across all branches. Fourth, STR is measured per branch per category with target set. 5. Written catchment steady for new branch, documented, not assumed. 6. Sanctioned CC or OD limit sized for the new branch's 90-day working capital. 7. Written return on investment projection with base, stress, and survival scenarios. 8. DSCR above 1.5 in every month of year 1, base case. 9. New branch budget provisions, that is 1.5 times the optimistic break-even timeline. Your existing best branch runs for 3 days without your physical presence. The last one, number 10, surprises people the most. But think about it. Your existing branch needs you physically present every single day to function. You don't have a branch, you have a job, and you cannot give a job to a new location. Now, based on the score, if you score between 8 to 10, then you are your expansion is ready. Proceed with confidence. The next branch is not a gamble, it's a calculated step forward. Your score is somewhere around 5 to 7. So you're close, but close is not ready. Fix the red items first. Give it 90 days, rescore, then decide. Don't rush. The opportunity will still be there. If your score is less than 5, then consolidate first. I know that's harder to hear, but expansion right now would stress the existing business. The discipline you build over the next 6 months is exactly what will make your next expansion actually work the way you dreamed it would be. Whichever score you are at, that's a clear path forward. So the scorecard isn't a verdict, it's a compass. So before we wrap up, 4 questions. Print this out, put them somewhere you will see before opening a new tab. So insist on writing all answers to all 4. Question 1. What will the customer actually buy? Is your product mix designed for the customer or copied from another branch? Question 2. When will the branch return the investment? Industry expectation is 3 years. If the answer is we haven't calculated, then the shop should not be opened. Question 3. Have you arranged CC or OD before opening? Your creditor is your partner. When you use them as a banker, you damage the partnership and still end up at the bank later at worse terms. Question 4. Can your existing branch run for 3 days without you? If no, the discipline to run the next branch doesn't exist in your business yet. It exists in you and you cannot be cloned. So we have covered a lot of ground today. Return on investments, funding structure, DSCR, a real case study from the audit file, a scorecard, and 4 questions you must answer before signing any lease. But if you take only one thing from the next 60 seconds, let it be this. The best retailers do not expand when opportunity knocks. They expand when their numbers say they are ready. Opportunity is everywhere. Readiness is rare. And ambition built your first store. Discipline builds your next 5. Most retailers never make that switch, and that is why most expansions underdeliver. Across the 3 speakers, across one powerful webinar, we didn't just talk about the retail expansion. We gave you a complete diagnostic framework, 5 signals, 5 questions, 5 things to answer honestly before you open a new store. So, on this note, I want to wrap up by saying thank you. It's a Saturday evening. You could have been anywhere right now, but you chose to sit in front of the screen on your day off and think hard about the balance sheets, DSCR ratios, and return on capital employed. So that's not normal. So because here's what I know what people would do. They are not the ones who wonder 5 years later why this expansion didn't work. They are the ones who look back and say, I saw it coming, I planned for it, and I was ready. So thank you for your time. Thank you for your attention. Have a great, wonderful weekend. Take care of yourselves.